Hey, welcome back to CryptoPhilly, where we decode the crypto universe one episode at a time. I'm Sean from CoinFlask, and today we're diving into something every crypto user needs to understand: tax reporting for crypto. Look, I know taxes aren't exactly sexy, but the IRS thinks they are. So if you've ever bought, sold, swapped, staked, or even just held crypto, this episode's for you. So let's get into it. Crypto is treated as property by the IRS, not currency. That means every time you dispose of it, by selling, trading, or even using it to buy coffee, you may trigger a taxable event. And yes, even if you didn't cash out to fiat, you could still owe taxes. Let's break it down. There are two key buckets to understand. One, capital gains taxes for buying and selling. Two, ordinary income taxes for earning crypto. Now, here are some common taxable events. The first, selling crypto for fiat. In other words, liquidating your crypto assets for physical, hard cash paper money, like cashing out Bitcoin to USD. Second, trading one crypto for another. For instance, swapping Ethereum for Solana. Taxable. Third, using crypto to pay for goods or services. Yes, that NFT hoodie you purchased also counts. And the last one, receiving crypto as income. Think mining, staking rewards, airdrops, or even payments for freelance work. All of that counts as a taxable event. Now, here's what's not taxable: simply holding your crypto or transferring crypto between your own wallets. Keep those distinctions in mind. They'll save you from over-reporting or under-reporting. Now, how do you report crypto on taxes? Well, you typically report your crypto activity in two main sections on your tax return. The first being Form 8949 and Schedule D. This is where you report your capital gains and losses, and you'll list each sale, the date acquired, date sold, proceeds, cost basis, and gain and loss. Yes, each trade. That's why using a crypto tax software can save your life here. And I'll recommend a few of those later as we go down the list. The other main section on your tax return is the Schedule 1 or Schedule C for income. Schedule 1 is if you earn crypto through airdrops, interest, or rewards. Schedule C if it's business income, like getting paid in crypto for services provided. But don't forget, the 1040 form now includes a yes and no question asking if you received or sold any digital assets. Be honest, the IRS is watching. So, common mistakes to avoid. Here are a few tax traps you'll want to sidestep. Not tracking cost basis. That's what you originally paid for crypto. Without it, you could pay more taxes than necessary. Then, forgetting about DeFi and staking rewards. These often fall through the cracks, especially if you're moving assets across platforms. And the one tax trap is assuming that the IRS can't track wallets. Spoiler alert, they can, and they do. Exchanges like Coinbase and Kraken use 1099 forms. Even wallets might get linked if you're not careful. So, transparency and record keeping are your best friends. Now, there are some tools and tips to stay compliant. Well, what's the best way to stay compliant? Use a crypto tax software like Coinly or CoinTracker or TaxBit. They plug into your wallets and exchanges, calculate your gains and losses, and generate the forms you need. Some also let you run tax loss harvesting reports to help minimize what you owe. Also, talk to a crypto savvy accountant, especially if you're trading at scale, using DeFi or living off chain income. Okay, so let's recap. Crypto is taxed as property, so buying and selling has its tax consequences. Every sale, swap, or income event should be tracked. Use tools, stay organized, and don't ignore the tax man, especially in crypto. So, if this episode helped you, make sure to subscribe, leave a review, and share it with the fellow degen who needs to stay out of the tax trouble. Thanks for tuning in to CryptoPhilly. Until next time, stack sats, not penalties.